What is the main purpose of conducting a human life value analysis during the insurance needs assessment? A. To calculate the cash value of an existing policy. B. To determine how much income person can insure based on future earnings. C. To estimate the loan eligibility of the insured. D. To identify the most tax-efficient investment strategies. The correct answer is B. To determine how much income a person can insure based on future earnings. Explanation: the human life value approach estimates the economic value of a person's future income over their working lifetime. It helps determine how much life insurance is necessary to financially protect dependents if the income earner dies prematurely. This approach is commonly used in personal insurance planning. Which of the following is typically not considered when conducting a capital needs analysis? A. Future education expenses for children. B. Outstanding debts and mortgage balances. C. Investment growth potential of the insurer. D. Final expenses such as funeral costs. The correct answer is C. Investment growth potential of the insurer. Explanation: a capital needs analysis estimates the total lump sum amount required at the insured's death to meet the family's financial needs. It includes final expenses, outstanding debts, and ongoing obligations like children's education. However, the insurer's investment performance is irrelevant to this analysis. In a business context, what is the primary purpose of a buy-sell agreement funded by life insurance? A. To attract new investors after the death of a partner. B. To allow for estate tax deferral. C. To provide capital for business expansion. D. To ensure smooth ownership transfer upon a partner's death. The correct answer is D. To ensure smooth ownership transfer upon a partner's death. Explanation: a buy-sell agreement funded by life insurance allows the surviving business partner S to purchase the deceased partner's share from their estate. This ensures business continuity and provides liquidity to the deceased beneficiaries without disrupting operations or creating ownership disputes. Which of the following life insurance strategies would best support charitable giving objectives? A. Assigning the policy to the charity as the irrevocable beneficiary. B. Naming the spouse as the contingent beneficiary. C. Taking a loan against the policy's cash value for donations. D. Using group term insurance to make annual donations. The correct answer is A. Assigning the policy to the charity as the irrevocable beneficiary. Explanation: donors can assign ownership of a policy to a registered charity and name it as the irrevocable beneficiary. This ensures the charity receives the death benefit and may allow the donor to receive tax credits on premiums paid. It's an efficient way to leave a lasting legacy. When does the free look period typically begin in a life insurance policy? A. From the date of application submission. B. From the date the first premium is paid. C. From the date the policy is issued and delivered to the client. D. From the date the underwriting is completed. The correct answer is C. From the date the policy is issued and delivered to the client. Explanation: the free look period allows policyholders to cancel the policy without penalty, usually within 10 to 20 days, starting from the date the policy is delivered. This right ensures the client has time to review the terms and make an informed decision. What is one of the most common causes of claim delays in life insurance? A. Claim submitted during the first policy year. B. Policy premiums paid annually instead of monthly. C. Incomplete documentation or missing death certificates. D. Policies issued to beneficiaries instead of the life insured. The correct answer is C. Incomplete documentation or missing death certificates. Explanation: the most frequent cause of life insurance claim delays is missing or incomplete documentation, especially the death certificate, proof of identity, or medical records. Prompt and complete claim submissions help expedite settlements. How does life insurance support retirement and estate planning? A. By serving as a substitute for public pension income. B. By providing tax-deferred interest on dividends. C. By generating lump sum payments for beneficiaries and offsetting estate taxes. D. By acting as a short-term investment option. The correct answer is C. By generating lump sum payments for beneficiaries and offsetting estate taxes. Explanation: life insurance is a valuable tool in estate planning as it provides liquidity to cover taxes, debts, or income replacement. It ensures that wealth is preserved and transferred efficiently, reducing the financial burden on heirs. What role does Insurtech play in modern life insurance administration? A. It replaces underwriting altogether. B. It eliminates the need for policy documents. C. It enhances efficiency through automation, analytics, and digital platforms. D. It only applies to group insurance markets. The correct answer is C. It enhances efficiency through automation, analytics, and digital platforms. Explanation. InsurTech, insurance plus technology, improves how insurers underwrite, issue policies, manage claims, and communicate with clients. Examples include chatbots, predictive analytics, digital onboarding, and AI-powered underwriting, all reducing processing time and improving customer experience. A key reason clients undergo a needs analysis before buying life insurance is to A. Determine the maximum premium the insurer will accept. B. Prevent duplication of policies across family members. C. Align coverage with financial obligations and long-term goals. D. Ensure the insurer remains competitive in the market. The correct answer is C. Align coverage with financial obligations and long-term goals. Explanation. The purpose of a needs analysis is to tailor insurance coverage to a client's specific situation, debts, income replacement, education funding, and future goals. It ensures the right type and amount of life insurance is recommended, promoting suitability and financial well-being. How did the COVID-19 pandemic most significantly affect the life insurance industry? A. It led to reduced death benefit payouts. B. It caused all policies to be converted into term plans. C. It increased consumer awareness and demand for coverage. D. It eliminated the need for medical underwriting. The correct answer is C. It increased consumer awareness and demand for coverage. Explanation. The COVID-19 pandemic heightened public awareness of health risks, prompting many to reconsider their financial preparedness. This led to increased life insurance inquiries, applications, and digital adoption. Insurers also adjusted underwriting protocols to address pandemic-related challenges. What is the primary purpose of life insurance? A. To provide tax deductions for the insured. B. To serve as a retirement plan substitute. C. To offer financial protection to beneficiaries in the event of the insured's death. D. To avoid probate court involvement. The correct answer is C. To offer financial protection to beneficiaries in the event of the insured's death. Explanation. The fundamental purpose of life insurance is to provide financial security to the insured's dependents or designated beneficiaries upon their death. It replaces lost income, covers final expenses, and can support estate planning or business continuity needs. It is not designed to avoid probate or serve purely as tax shelter. Who among the following must have an insurable interest in a life insurance contract at the time the policy is issued? A. The beneficiary. B. The insurance company. C. The policy owner. D. The agent. The correct answer is C. The policy owner. Explanation. For a life insurance policy to be valid, the policy owner must have an insurable interest in the life of the insured at the time the contract is initiated. This means the policy owner must stand to suffer a financial or emotional loss if the insured dies. Without this, the contract is considered a wager and is legally unenforceable. Which type of life insurance provides coverage for a specified term and does not build cash value? A. Whole life insurance. B. Variable life insurance. C. Universal life insurance. D. Term life insurance. The correct answer is D. Term life insurance. Explanation. Term life insurance provides coverage for a limited period, such as 10, 20, or 30 years. It is pure insurance offering death benefit if the insured dies within the term, but it does not accumulate cash value. It's commonly used for income replacement or temporary needs. In a life insurance contract, who has the legal right to change beneficiaries, assign the policy, or surrender it for cash value? A. The policy owner. B. The insured. C. The insurance agent. D. The beneficiary. The correct answer is A. The policy owner. Explanation. The policy owner holds all legal rights over the life insurance contract. This includes making beneficiary changes, accessing policy loans or cash value, and surrendering the policy. The insured may be a different person, but the owner is the one who controls the policy. Which life insurance policy combines the flexibility of premium payments and death benefits with a cash value component that earns interest? A. Term life insurance. B. Universal life insurance. C. Group life insurance. D. Variable life insurance. The correct answer is B. Universal life insurance explanation. Universal life insurance allows for flexible premium payments and adjustable death benefits, and it accumulates cash value at interest rates set by the insurer. It is more adaptable than whole life, but still considered a permanent insurance product. What is the function of an accidental death rider in life insurance policy? A. It waives future premiums in case of accidental death. B. It provides additional coverage for family members. C. It covers death due to any cause including illness. D. It increases the death benefit if the insured dies due to an accident. The correct answer is D. It increases the death benefit if the insured dies due to an accident. Explanation. An accidental death rider pays an additional death benefit if the insured's death is due to qualifying accident. For example, if $100,000 policy has $100,000 accidental death rider, the beneficiary would receive $200,000 for qualifying accidental death. It excludes death by illness or NAP. What is the standard grace period provided in most life insurance policies for premium payments? A. 31 days, B. 10 days, C. 60 days, D. 90 days. The correct answer is A. 31 days explanation. Most life insurance policies provide a 31-day grace period during which a missed premium can still be paid to keep the policy in force. If the payment is not received by the end of this period, the policy may lapse unless it has a non-forfeiture option or automatic premium loan feature. Which of the following is a non-forfeiture option available to policyholders of permanent life insurance? A. Reinstating the lapsed policy without conditions. B. Waiving the death benefit. C. Increasing the policy's face amount. D. Extended term insurance. The correct answer is D. Extended term insurance explanation. Extended term insurance is a non-forfeiture option that allows the policyholder to use the cash value from a lapsed policy to buy term insurance for the same face value for as long as that cash value can cover it. It ensures that the insured retains some form of coverage. What is one key difference between variable life insurance and whole life insurance? A. Whole life insurance offers no cash value accumulation. B. Variable life insurance provides no death benefit. C. Variable life insurance allows policyholders to choose investment options for cash value. D. Whole life insurance has flexible premiums. The correct answer is C. Variable life insurance allows policyholders to choose investment options for cash value. Explanation. Variable life insurance gives the policyholder control over the investment of the cash value component, which can increase or decrease based on market performance. Whole life insurance, by contrast, offers guaranteed cash value and fixed premiums with no policyholder-directed investment risk. In a group life insurance policy, who typically holds the master contract? A. The insurer. B. The employer or organization. C. The insurance broker. D. The group member. The correct answer is B. The employer or organization. Explanation. In group life insurance, the employer or sponsoring entity holds the master contract. Individual members receive certificates of coverage, but they do not own the policy. Group life is commonly offered as an employee benefit and is typically not medically underwritten for each participant. What is the primary goal of the life insurance underwriting process? A. To minimize the insurer's investment returns. B. To ensure all applicants are offered the same premiums. C. To evaluate risk and determine appropriate premiums and coverage. D. To deny coverage to high-risk individuals automatically. The correct answer is C. To evaluate risk and determine appropriate premiums and coverage. Explanation. The underwriting process in life insurance is designed to assess an applicant's risk level based on health, age, lifestyle, and occupation. This evaluation helps insurers determine whether to issue the policy, at what premium, and under which terms. Which of the following is not typically a risk factor considered during the underwriting of a life insurance policy? A. Occupation. B. Marital status. C. Age. D. Smoking habits. The correct answer is B. Marital status. Explanation. While factors like age, health, occupation, and lifestyle choices, e.g., smoking, directly affect life expectancy and risk, marital status is generally not a key factor in underwriting risk unless it's related to financial dependency or insurable interest. Which of the following best describes non-medical underwriting in life insurance? A. Issuing policies to clients without any risk assessment. B. Underwriting that uses detailed lab reports and physician examinations. C. Assessing risk based on answers in the application and minimal medical evidence. D. Automatically approving applicants who are under age 30. The correct answer is C. Assessing risk based on answers in the application and minimal medical evidence explanation. Non-medical underwriting evaluates applicants based on information from the application, including lifestyle, occupation, and self-declared health status. No physical exam is typically required unless the coverage amount is high or answers raise red flags. A life insurance applicant qualifies for preferred rates. What does this mean? A. They are offered higher than standard premiums due to health issues. B. They are only eligible for term life insurance. C. They receive low premiums due to better than average health and lifestyle. D. They are automatically given permanent insurance without underwriting. The correct answer is C. They receive lower premiums due to better than average health and lifestyle explanation. Preferred rates are reserved for applicants with excellent health, normal weight, no dangerous hobbies, and good family medical history. This classification rewards low-risk clients with reduced premiums compared to standard rate applicants. How are life insurance death benefits typically treated for income tax purposes in Canada? When paid to a named beneficiary, A. They are partially taxable based on the size of the policy. B. They are taxed as capital gains. C. They are tax-free. D. They are taxed as dividend income. The correct answer is C. They are tax-free. Explanation. Under the Income Tax Act of Canada, death benefits paid to a named beneficiary other than the estate are generally received tax-free, making life insurance an effective estate planning tool for protecting family wealth. Which of the following statements about policy loans from a permanent life insurance policy is correct? A. Policy loans are tax-free and do not need to be repaid. B. Policy loans are always considered taxable income. C. Policy loans are not subject to interest. D. Policy loans may be taxable if the policy lapses with an outstanding loan. The correct answer is D. Policy loans may be taxable if the policy lapses with an outstanding loan. Explanation. While policy loans themselves are not immediately taxable if the policy lapses or is surrendered while a loan is outstanding, the loan amount in excess of the adjusted cost basis act may be treated as taxable income. Which regulatory body supervises life insurance companies operating federally in Canada? A. CELIA. B. FRA. C. IRUC. D. OSFI. The correct answer is D. OSFI. Explanation. The Office of the Superintendent of Financial Institutions (OSFI) oversees and regulates federally incorporated life insurance companies in Canada. It ensures financial soundness and compliance with relevant laws and capital requirements. The primary purpose of Know Your Client (KIC) requirements is to A. Sell more insurance products per client. B. Collect enough personal information to enable telemarketing. C. Detect and prevent money laundering and ensure suitable recommendations. D. Reduce the number of applications rejected. The correct answer is C. Detect and prevent money laundering and ensure suitable recommendations. Explanation. KIC rules ensure advisors gather sufficient information about clients to assess their needs, identify risks, e.g., money laundering, and recommend appropriate insurance products. This supports compliance with ML, anti-money laundering regulations, and ethical standards. When replacing an existing life insurance policy, which of the following is a regulatory requirement? A. No documentation is needed if the new policy has better coverage. B. The advisor must submit a replacement disclosure form. C. The client must notify the existing insurer directly. D. The advisor must wait 90 days between policy cancellation and new application. The correct answer is B. The advisor must submit a replacement disclosure form. Explanation. Replacement disclosure rules are in place to protect consumers from unnecessary replacements. Advisors must complete and provide a replacement disclosure form that explains the differences between the old and new policy, ensuring the client makes an informed decision. An insurance advisor exaggerates a product's benefits to close sale. This is an example of A. Ethical persuasion. B. Replacement compliance. C. Product bundling. D. Misrepresentation. The correct answer is D. Misrepresentation. Explanation. Misrepresentation occurs when an advisor provides inaccurate or misleading information. intentionally or not. It is an unethical and potentially illegal sales practice that can result in disciplinary action and policy rescission if discovered.